Did you always want, a fixed amount of money when you went into old age, or you're just so scared of investing in a little bit more riskier uh, type of investments that maybe fixed income is sort of your go-to choice? Well, today I'm going to be explaining to you why maybe fixed income isn't actually a great long-term idea. My very first argument is the very notion of fixed income. You get the same amount of income from say, your bond, and that's pretty much it. No matter how long you sort of hold this product or this bond, you're going to be getting the same amount for as long as you hold it. And that kind of poses the problem of, say, if your lifestyle changes, instead of one apple, you need to buy three apples because now, say, you've had a child or you have two children, then naturally you need to buy more. It's a lifestyle sort of inflation. So having that same amount doesn't really afford you more. It just gets you the same. And why I prefer equities over fixed income is that there's always a chance that dividends, which is, I would say, sort of the equivalent to fixed income in bonds, dividends by companies have a chance to grow because companies can increase the rates that they pay you out. But at the same time, there is a chance where the company is not great and they can also decrease it. But that's sort of how, legendary investors such as Warren Buffett, they buy stuff really early, and dividend growth from very good companies grow over time, say like over 10 years. And pretty much the original dividend that you were starting with has more than, doubled or multiplied by 10. So really, from not even buying more of your equity investment, your dividend from one apple just became 10 apples. My second argument is inflation pretty much gets the better of you. So kind of referring back to the Apple case, your one apple, say if it costs $1, it just naturally just increases in the cost. So it goes from, say, $1 to $1.05. And if your fixed income only gives you $1, that means you can't afford that apple anymore just because you don't have that extra 5 cents. Now, that's a problem because over time, this sort of case gets worse. That's how you sort of see an apple go from $1 to $2. And there's just no way a person on fixed income should be able to afford anything, having the same income over time. Now, I know there are sort of inflation adjusted fixed income, so it increases with the rate of inflation, but that's sort of just a matching feature. So over time, you can only stay with buying one apple. So in the first year, you get $1. The next year, you get $1.05. But then the price of the apple also matches, right? Thirdly, if say you are investing in some fixed income that's a little bit more risky, such as a corporate bond, so the company gives out a higher rate of income, but the only reason why it's more risky is because the company has a chance of not paying back its debt. Just because, say, today Coca-Cola is really successful, there may come a day where Coca-Cola is no longer popular, or they just come into some financial trouble and they just can't pay back their debts. So essentially, they go and run into trouble and they end up not paying you back your money. My last argument is I just don't think fixed income is really compensating you enough for your time and money. When a bond such as a corporate bond could be paying out 3% every year, say after 5 years, 3% times 5, you're pretty much getting 15% after 5 years. And in my opinion, that's sort of a joke compared to a lot of the equities that can potentially pay out a lot more. The stock market on average pays out 7%, you know, including all the up and down cycles. When you average it all out, you should be sort of expecting 6 or 7%. These past few years, I've noticed the most basic stock, S&P 500, kind of pays out 10% and almost a 2% dividend. And don't forget that 2% grows over time. There are companies just like as simple as Amazon over 5 years can get you like 400 or 500%. And I just can't understand how long fixed income would take in order to get that same return. Maybe the extra risk is worthwhile to get that extra return because there's just no way, or there's just not a lifetime where you can possibly make that much just under fixed income.